All right, class, we'll be going right into Module 5. We're going to be looking at cost of capital. We're going to talk about both the company and a project level. We're going to talk about measuring the cost of equity, analyzing risk, and then we're going to talk about certainty equivalence, which is another way of doing these calculations. We're then going to transition on and look at sensitivity and scenario analysis. We'll look at break-even analysis and operating leverage. We'll understand Monte Carlo simulations, and then we'll talk about real options and decision trees. Okay, so when we're talking about the company and the project having a cost of capital, what this is, you can think of the firm as being the present value of all of the future cash flows. And so as we're adding additional projects, we can look at the present value of the cash flows associated with those projects. And that's a lot of the decision that we make around projects is this adding value to us? And so this is showing the relationship between the company's cost of capital, which we may calculate to be 7.7%, but we would only do that if the project's beta would be equal to the company's beta as a whole. So if this project is more or less risky than all of the other projects on average, then it would not be appropriate to use that same discount rate. We should use one appropriate for the level of risk for those cash flows. And this is ways of calculating that cost of capital using the debt and equity of the firm, because we have different rates of what's required for debt holders versus what's required for equity holders. So the required return on assets is equal to the return on debt, and the return on equity weighted as to how much of the firm is debt or equity. Now we live in a tax world, and so when we're calculating the cost of capital, we'll normally use the after-tax weighted average cost of capital, where we still weight debt and equity based upon the proportion of the firm made up of debt or equity. But the rate required for interest payments will discount by the tax rate to account for the tax shield. When we're measuring the cost of equity, right, we can think of that before we were using CAPM to get the return for the firm. And so we can think of the return required on equity, right, being equivalent to that, since that debt is a fixed amount. So to estimate beta, right, we use the security market line to show that relationship. When we use the CAPM, we're using beta as a proxy for risk. It's that relationship with the market risk. Other methods can be employed, right? So we can get other measures for the security market line to give us that beta, right? But let's look at some examples. This is US Steel over 2 different periods, and you notice the beta is slightly different over those. Here's an example using Microsoft. This is Consolidated Edison. You may have heard it called Con Edison. They do utilities in New York, so they're you hear it a lot in television shows set there. And the slope shows you that basically the riskiness, how sensitive you are as you're adding more and more risk for your returns. And it's just to show some examples of estimated betas for firms and then the standard error around that. So in this particular case, these are all railroads of different sizes. Canadian Pacific is not within the United States. CSXT, Norfolk Southern, Union Pacific are all the major railroads, the type or the class 1, I think it is. The other one is BNSF, Burlington Northern Santa Fe, but that one's owned by Warren Buffett's company, Berkshire Hathaway. But this is comparing railroads. Genesee, Wyoming is going to be like a tier 2, that smaller railroad. But you see their betas, and then you can see an industry portfolio and what that would look like. So for our company, when we're trying to calculate the cost of capital, it would basically be, well, what is the beta of all these different assets, right? Because the firm is made up of these assets. And so you could look at that as, well, I know the beta of the assets is going to be beta of the debt and beta of the equity, weighted based upon how much of the firm is debt and how much of the firm is equity. We can also calculate beta using our operating leverage. So you can think of the beta of fixed costs and the beta of variable costs, right? And how those relate to revenue, and then the beta of our assets based upon our ability of the assets to generate revenue. Right, we can simplify that to come up with the beta of the asset being equal to the beta of the revenue of 1 plus the present value of those fixed costs divided by the asset, present value of the asset. Okay. The reason for doing this calculation is it starts allowing for us to have like defaults, right? Bad outcomes can occur, right? And that type of thing. So we'll look at some risk involved. So here's an example. This project is going to have one cash flow. It's estimated to be $1 million in a year, right? So we feel it's appropriate to discount that at 10%, right? And then so we can calculate what the present value would be today using our standard calculation for present value. But now we found out that things aren't quite going the way we hoped, right? It's still most likely that we end up, you know, with our million, right? That's possibility, but there's a 25% chance that we're doing better, and then a 20% chance that we're doing worse, right? Or 25% chance that we're doing 20% better, and a 25% chance that we're doing 20% worse. Sorry, I need to state that clearly. And so if you just multiply those possible cash flows times the probability of that cash flow, we can add those, and then it would give us our forecast of what we think we're going to have for the next period, right? And so in this case, we still expect to get $1 million. We just know that instead of a guaranteed million, there's only a 50% chance it's exactly $1 million, and then it could be plus or minus 200,000. Okay. And then what about if there's like some chance and they just proportionately knocked it down? There's a 10% chance that they just can't get it done at all, and we get no dollars, right? And so we can put that in, and then with our unbiased forecast, calculate what the present value of that cash flow would be. And as you see, it would be less in this case because we have that uncertainty. And this is just to show sort of how you can make corrections when people have had optimistic forecasts, right? And so if you need to make those corrections, following that example from the book. This is just to help you see that if we are trying to discount, but by having that overstatement, right, of that 12% instead of the 22%, right? That's where you're seeing that discrepancy. And so they've had to correct the cash flows to account for that. Okay, an alternative, instead of using that discount rate that we've been using, we can use a certainty equivalent, but we should end up in the same place, regardless of how we do this. So we're going to look at this so we can discount for time and risk, right? And that's our risk adjusted discount rate method. So you just say, okay, we are going to account for them both, or you can take the risk portion first, and then once we've accounted for that, take the present value for the time portion, and that's that certainty equivalent. So we're doing the same calculations. In one case, they're broken apart into a risk piece and a time portion, and the other one we just discount for them both at the same time, but we should come to the same present value. And this is an example. We have a cash flow of 100 million for 3 years. We're given a risk-free rate and a market risk premium. We have a beta, so we can calculate what's the present value of that project. So we have our discount rate given that information. Taking that discount rate, we have our cash flows of 100 million a year. Discount that back over 1, 2, or 3 years. Add those up, and that will give you the present value of this project. Right. So in today's dollars, it's worth 240 million to have that 100 million for 3 years, given that 12% discount rate. Okay. Well, what about if it now assume that the cash flows change, but they are risk-free cash flows, right? So and right, so now with those cash flows, you see how it's the certainty equivalent for each of those, the 94.6, the 89.6. When we calculate the present value, just looking at the risk-free rate, so it's the 6% instead of the 12% for the risky firm, right? We still end up with the same total present value. And so that 94.6 for certain is equivalent to our 100 that's risky, right? And that's why we call it that certainty equivalent. So in the first one, you notice you just took all your cash flows and you discounted it 12%. 6% is for that risk-free portion, and then the rest of that is for the risky portion. Or we can just take the certainty equivalent, so pull out the risk portion, and then you have just the 6% risk-free rate. But either way, you'll come to the same place. Okay. And so we have this project, and you notice that we have our cash flow, we have our certainty equivalent. And so since those are dropping by a set amount, that is known as that deduction for risk, right? This is how much we're reducing this value to account for the riskiness of the cash flow. Okay, here's a continuing on. So now let's see. Oh, okay. So we're evaluating the same thing. But since we have that difference, right, but it'd be like a par value and then a discount that is being sold at, right? And so they can use that to say to get our certainty equivalent cash flow, we just discount the risky cash flow by 1 plus that premium. And so we can look at each of those cash flows and then discount it at that 1 plus the risk premium and get those certainty equivalents. So again, it's just a way if you want to decompose the risk portion from the time value of money, right? Or we can just include them together. And that's what we're showing. Okay, so let's go ahead and move on to sensitivity analysis. And this is how we could have a same expected cash flows, but one of the cash flows could be much more sensitive to some change in something else. And because it's so sensitive to that, small changes can make it suddenly a much better or much worse project. So we want to make sure we understand how sensitive we are. So we're going to look at this project for the next several slides. We have this electric scooter company. They sell those little scooters to the city, and then the people can use them to ride around. And we're going to have a cash flow forecast on the next slide. And just notice the NPV is positive, the net present value. If it were not positive, we wouldn't consider it probably, right? And it's positive at a 20% cost of capital. Okay. And so here's what we're looking at, right? So initially we have to pay the 15 million. You see that on line 1 or 15, whatever these are. And then you notice we have this cash flow from investment working capital, because we're going to have to like put some money aside probably for supplies and things like that. But you notice we start recouping that near the end of the project. You see the number of units being sold. So we're going to ramp up. And then slowly start ramping down, probably go to a new unit after 10 years, probably have a new design. Unit price, you see it's listed there in millions. That's a yen symbol, so this must be a Japanese company. And then you just see they just work through how to get to what the cash flows are, and then calculating what the net present value of those cash flows are at that 20%. You get at the very bottom an NPV of 2.02. Right, so it is a positive NPV project given these cash flows. Okay. So yeah, this is some of the stuff that I was just saying, right? So we're gonna have to invest. It's 15 billion. Those were in billions. Okay. And then after year 6, they're expecting things to start tailing off because you'll have other things, right? And then you see the assumptions that they're making for cost of goods sold, taxes, and the depreciation. And then what you do is you just start looking at the most pessimistic and most optimistic, and then just see how does that change the NPV. And these are just some examples, right? What if it ends up costing us more? What if it ends up costing us less? What if we need a lot more supplies? What if we need fewer, right? What if we sell lots more? What if we sell fewer, right? What if we can sell them for more? What if we have to sell them for less, right? What if our cost of goods are a lot cheaper, right? Or what if it ends up costing us a lot more, right? And then fixed cost, what if it's lower? What if it's higher? So just changing those things, it changes the NPV of the project because those cash flows are obviously different, right? But we can look and see which things changing cause the larger swing higher or lower, right? And so we can look at those and we can see what things we really need to keep an eye on, because it will give you a sense of which things seem to influence NPV more if it were to be high or low. So it's not perfect, right? So when we have this sensitivity analysis, we're not sure if we have all of the appropriate variables. We're not sure if we're collecting the right type of data to do the analysis. Even if we were, how exactly should we interpret some of these things? And you notice that last bullet point, underlying variables are likely to be interrelated. So it's hard to tease out how much is controlled by one or the other because two or three things are related to each other, right? So if I'm, um, doing changes in one part of the company, it will necessarily change other parts of the company, right? And so that's what we're seeing here. And this would be some sort of outside shock. So this is nothing within the firm, but just saying, well, what if we had higher oil prices, right? Suddenly the electric scooters probably look, very different, right? But then what if inflation's higher, right? Because that'll affect things like pricing and things like that. So based on that, we would be able to calculate a new NPV, right? So they can have these outside shocks, not just things that we control with internally, right? Another thing that we can look at is what's known as break-even analysis. And so this is just to say, like, when would we basically make the money back, right? So yeah, I'll show you a table. Okay. So basically, if our capital investment has to go up by 16.2%, then that's where we would cross to being an NPV 0, right? Working capital, that really has to shoot up. Working capital is not a lot of money, right? So it takes a lot more for it to have a big impact. Sales, the sales are down 6.3%. This is not a money maker, right? So we know that we better watch our sales, right? Cost of goods sold, because we were saying 50%. If it only goes up to 53.2%, right, that's enough to make it. So we better control our costs, right? So this is some of the changes that we can look at when we're trying to decide that. Also looking at by year. We can start looking at, well, what do sales need to be, right, as we go forward for us to be able to not lose money, at least, right? And you see how much they have to have as revenue, right? Given that cost of goods sold takes out half of it, given that we know what these fixed costs are going to be, right? We subtract those all off. We have to have enough income to cover the depreciation of the assets, right? And so a pre-tax profit of 0 obviously is not what we want, but at least it's not negative, right? We're hoping to have that avoid that accounting loss, right? So that tells you what your revenue has to be, what your sales have to be each year to avoid that. Okay. Operating leverage is this like ratio that shows you what is fixed, what's the ratio of fixed to variable, right? And then this degree of operating leverage is what is the percentage change in profits with a 1% change in sales. Okay. And so this is important because if you have a lot of fixed costs, as you add more and more sales, you do make some money, but so much of well, what if you have a high percentage fixed cost, low percentage variable costs, as you're selling more and more, it's a lot more profit, right? But if you have low fixed costs, high variable costs, your costs are going up a lot more with your sales. So that's why we care. That's why it's a percent change in profit based on percent change in sales. It's not 1 for 1 because part of it is fixed and part's variable. So we're going to use the same scooter project that we had, right? And if we go back and look at the data, this we'll stop for a moment. You can skip back and look at where year 2 was, right? So for our depreciation, and put this in, and then we'll discount that back, and you see the operating leverage that we have is 4.5. So if our sales will go up 1%, our profits will go up 4.5%, right? Percent change in profits over the percent change in sales, right? So that's what you're seeing there. Okay, another thing that we can do are Monte Carlo simulations, right? So the first thing you have to do is you make your model, right? So we model what this thing is going to look like, you know, what's possible, and then we start talking about what's the probabilities associated with those, right? And then you just run a simulation. You know, you just kind of hit enter on the random number generator, let it start running through and calculating, you know, what it could be, right? And then based on that, we can calculate what the present value is, right? And the beauty of the Monte Carlo simulations is you can run, you know, thousands, tens of thousands, hundreds of thousands of simulations. And this helps you understand the sensitivity that you have to different things. Right. And so this is if we're trying to do the same thing with our company, right? And it shows you there that Monte Carlo is famous for their casinos, and this is where this comes from, you know, basically trying to figure out what's the probability of wins and losses within a casino. And then it's the same thing. We're calculating the probabilities of cash flows given our choices. The last way we're going to start looking at things is as real options and decision trees. So we got to define those for you. So a decision tree is basically just trying to map out all of the choices. Would it go up? Will it go down? And then once I decide I'm going up, okay, now you're up. Will you go up? Will you go down? And I can think of that like going down branches on a tree. Right. And so you determine what the options are, like where these choice points would be, and then what the outcomes are. And options have value, right? So an option that helps me save money, an option that helps me make money, there's value to that, right? And since I'm creating this option, then that's something that I can buy or sell, right? It has value. So we're going to look at an example of UPS expanding. So they have an option, right? They acquire that option and they look to see, is there demand, right? If there is high enough demand, they exercise the option and they have this new cash flow. If there's low demand, they don't take the option, right? So they didn't do the initial investment. They waited to see, but they had the option in place. Okay. So some examples of these types of real options, and we call them real options because it's not a financial option like a derivative security. This is like a project you can do. It's a real option you can act on. And so you can choose to expand, right? That would be an option. You know, I've got things in place and then I can make a phone call and start expanding, right? Or an option to abandon. You can't always walk away from things. We have regulations in certain areas and that types of things, but having an option to walk away from a bad deal, there's value there. Different ways of doing production, right? And those options, different ways of timing when things are going to be paid, right? These are all those real options that we need to put a value on because those options have a value. So this is a decision tree, for a particular company. They have the option of a couple of different technologies. So if they were to go technology A, right, then the demand gets revealed. And if they were to go buoyant, they receive this much money. If it's sluggish, then it's this much money, right? If they were to go technology B and it's either buoyant or sluggish, then we have to decide, okay, well, are we going to continue or are we going to abandon? Right. And then based upon that, they have different cash flows, right? And so we would be able to calculate, the value of those options today. A different type of project Could be something like research and development, right? And if you notice, they start saying, okay, should I invest now? This is a 2-year project, right? And then as we're going through it, we start getting failures, right? As we're doing all of our different testing. And then at some point, we understand that there's different probabilities. We're in different states of the world, but we don't know which one. So we have to decide if we need to make this investment, right? And then if we do, we get either success or failure from the final approval, right? And then you see what those outcomes are, and then we could calculate what is the present value today, given these probabilities that we're going through that. So one problem is they get complicated quickly. You saw those, and we weren't having a lot of decisions. But it does allow you to get a sense for what choices you have coming up, when these choices need to be made, what value there is in doing that. Because by taking advantage of these options, you can maximize the value for your firm. All right. Well, that concludes module 5. Thank you so much.